Hi everybody. In this video we're going to continue discussing the accounting equation. Take a quick overview of what we talked about in the last lecture. The basic accounting equation is assets equals liabilities plus owner's equity. And equity is influenced and changed by the activities of the company. Equity is decreased when the company pays dividends. Equity is increased when the company earns revenue. And equity is decreased when the company incurs expenses. Therefore, the expanded accounting equation is assets equals liabilities plus owner's equity minus dividends plus revenue minus expenses. That expanded accounting equation is the foundation for recording all business transactions. So it's important that you memorize that equation. There's not a lot I'm going to ask you to do in this class as far as memorization is concerned, but memorizing the expanded accounting equation is very, very important. Please take some time to memorize assets equals liabilities plus owner's equity minus dividends plus revenue minus expenses. So let's expand on that and ask, well, what are assets? We found the definition in our last recording to be resources owned by the business that will be used in a future period. Let's look at some examples of assets. Probably my favorite asset is cash. Accounts receivable is an asset, as well as supplies, inventory, vehicles, office furniture, office equipment, land, prepaid expenses. All of those are examples of assets. See if you can think of more examples of assets that a company might own. What about liabilities? Well, we saw in our last recording that liabilities are creditors' claims against the assets of the company, which is the same thing as saying the debts of the company. Let's look at some examples of liabilities. Accounts payable, notes payable, wages payable, taxes payable, and unearned revenue are all examples of liabilities. Notice that many of the liability accounts have one word in common, the word payable. A payable is a bill that has to be paid in the future. A company is going to have to use some asset, probably cash, to pay off the liabilities. In a simple corporation, there are only two permanent equity accounts: common stock and retained earnings. A dividend is a payment to the company's owners, who are also known as stockholders or shareholders, and the payment is made from the accumulated earnings of the company. Basically, a dividend gives some of the company's equity to its owners. A dividend is not classified as an expense of the company because they do not help to earn revenue. The revenue account titles would depend on the type of business in which the company is engaged. For instance, if I earn my revenue by doing consulting, then my revenue account title might be consulting fees or consulting income or consulting revenue. If there are other kinds of fees that I earn, maybe my income account would be titled fees income. If I earn revenue by providing services, then maybe my revenue account would be entitled service revenue. And maybe my business sells products. In that case, the revenue account would simply be sales. Expenses are incurred in order to earn revenue. We're most likely not going to stay in business unless we incur some expenses. It would be foolish to incur unnecessary expenses, but a company might need an office from which it does business, so it might incur rent expense. It may be necessary to hire employees, so the company would incur salaries expense or wages expense. Insurance is important to the operations of a business, so the company may incur insurance expense. Paying telephone and utilities would be recorded in an account called telephone expense or utilities expense. I'll bet you can think of a whole bunch more expenses that must be incurred by a company in order to stay in business and earn revenue. Well, that's all for this video. When we come back in our next video lecture, we are going to learn how to record business transactions in a worksheet. See you next time.